That's closing bell on Wall Street, and now it's market domination. Over time, we're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Hennion and Walsh CIO, that would be Kevin Mahn, as well as Yahoo Finance's Jared Blikre, joining us here to break down the moves today. Jared, let's start with you, my friend, on the close. We do have fresh records?
Yes, we do. In terms of the S&P 500, the Nasdaq Composite, and the Nasdaq 100, couple sectors, more on that in a minute. First, I just wanted to show you the Dow here just barely closed in the red. We were green all day and then just lost it in the last few minutes, so we did have a mixed day. Nasdaq Composite leading up about 0.4%. You can see here well off of its highs from earlier in the morning. And here's the S&P 500 up a whopping 15 or 14 basis points. So not a huge day in the indices, but this is a lot of what we see in these bull markets. You don't see a lot of volatility at the highs, and we certainly did not see that today. I'll also show you the small caps. They fell deeper into the red than the Dow, closing down about 0.25%. Really interesting day in the bond market. I'm going to go to the 10-year T-note yield first. It was down 6 basis points to 4.37%. The 30-year, which I've been talking about quite extensively, well below the 5% line right now. That was down 6 basis points, and that was the biggest drop in a few weeks there. And in sympathy with rates, we also have the U.S. dollar index down 0.2%. That's a fairly sizable amount for a currency, much less the world's reserve currency. And now I will get you to some sector action where we see communication services, best day in, I believe it was 5 weeks, of 1.37%. Materials, consumer discretionary also leading there. To the downside, we did have energy closing down more than 1%, and then healthcare, industrials, financials, and staples also in the red. And then on to the Nasdaq 100, we have NVIDIA, pretty close to record highs, but not one today, down 0.6%. I mentioned communication services, the number one sector. The two biggest stocks in there, Google and Meta, each of those, not T-Mobile, each of those up more than 1%. Alphabet almost up to 3%. Amazon also closed in the green, about 1.5% up, and Broadcom slightly more than that. Tesla also one of the Mag 7 in the red today. And also the Mag 7 index itself is getting pretty close to a record high. I'll be talking about that with Josh in about 30 minutes here. And then let's take a look at the Dow, where we see Verizon up about 4%, Nike up 2%, Home Depot up more than 1%. So is Amazon. So two consumer discretionary stocks there in the green. And then we got some red as well. Besides NVIDIA, we got American Express down 1.5%, Travelers down 1%, and it looks like Disney down about 45 basis points. Josh?
All right. Thank you, Jared. Kevin, your thoughts on the latest moves?
The bull market continues, and what a bounce back it's been since the initial shock of the tariffs that were announced back on Liberation Day. And I believe that investors are becoming more and more comfortable with the resiliency of the U.S. economy. Last week, we saw retail sales come in above expectation, jobless claims come in below expectations, and in all likelihood, the Federal Reserve will deliver at least one, possibly two rate cuts of 25 basis points each. If they do, the momentum behind this bull market may continue, but not without some more short-term bouts of volatility along the way.
We just heard Jared say that Mag 7 getting close to a record high. There is an argument out there, Kevin, I'm interested to get your thoughts on this, that you know what? You don't actually have to overthink this. Just watch the Mag 7, watch big tech, and of course those earnings are on deck. And as long, Kevin, as those companies are performing and hitting their bogeys, you stay long the market. What do you make of that argument? Is that too simple?
I think it's almost too simple, but there's something to be said about staying invested in technology. But overall, investors shouldn't try and time the market. Look, I've been doing this 32 years. I can't time the market because you need to get it right twice, when to get out and when to get back in. So stay true to your risk tolerance. Mix in technology names into your portfolio, but there's plenty of other investment opportunities out there as well if you follow where all the money is going in terms of spending.
All right. Meanwhile, shares of Trump Media and Technology Group, they're getting a lift in today's trade after revealing the size of its Bitcoin treasury holdings. For more, let's get to Yahoo Finance's David Hollerith. David.
Josh, so the president's namesake media group previously announced plan to acquire Bitcoin. This morning they said that they had acquired approximately $2 billion worth of Bitcoin. And their total balance sheet is about $3 billion in assets. So that's 2/3 of their balance sheet. And this is a part of a wider trend that we've seen of companies effectively following the strategy that Michael Saylor's company, formerly MicroStrategy, now Strategy, sort of started doing in 2020.
The idea here of a treasury Bitcoin, a Bitcoin treasury company, David, explain just a bit more for the audience about what that is, the point and purpose, why it's become this hot trend.
Yeah, Josh, it actually isn't that complicated, although it can be complicated. Effectively, Michael Saylor's strategy has been purchasing Bitcoin periodically since 2020, and the stock investors have sort of rewarded his pursuits in that, and the company, which is effectively mostly the value of the Bitcoin it acquires, trades at a premium to the value of the Bitcoin it holds. And so there's kind of this phenomenon that's been happening in which if you put Bitcoin or other crypto assets on a balance sheet, at least right now, the value of the stock of the company that does that trades at a premium. Not everybody agrees that this can continue for a long time, but every company we've seen, or nearly most, I guess you would say, this year that have done such a move and issued equity or debt to acquire more Bitcoin have seen higher stock returns.
Yeah, there are skeptics, David, right? Some very well-known skeptics. You think of guys like Jim Chanos. Why are they skeptical?
Absolutely. I mean, it just goes back down to the price of the crypto assets these companies hold versus how much their stocks trade at a premium. Now, proponents sort of say that the reason why they trade at a premium is because there's interest and trust in management of potentially acquiring more of the cryptocurrency in the future when the value is higher. For Bitcoin, there's a finite supply, so there's that argument there. There are obviously other vehicles for stock investors to get exposure to cryptocurrencies. So it's a bit of a phenomenon that, I think some, college business professors and short sellers, for instance, don't really agree with and they think can't last forever. So that's kind of the great debate happening right now between Chanos on the one side, Saylor on the other.
All right, that's a big debate, big names in the ring. Thank you, Dave, appreciate it. Turning now to what investors should be looking at in the coming months, Kevin, keep an eye on some key themes in the second half of the year. Let's run through these, my friend.
Sure.
We'll go through three of them, rapid fire. All right, one you talk about, here's the first Kevin theme, the long game of artificial intelligence investing.
Yes.
You call out Taiwan Semi, which has it's up around 20% this year. I know some on the street, they worry about tariff impact to demand being a risk this year, but walk me through how you're thinking about that name.
Taiwan Semiconductor, the largest dedicated chip foundry in the world with a 60% market share. You know who their largest client is? NVIDIA. Everyone thinks NVIDIA makes their own chips. They
generally
don't.
Speaking.
Taiwan Semiconductor makes their chips. They just lifted their full year guidance by 30%. And we also know that NVIDIA is looking to onshore the production of their chips into the US. Taiwan Semiconductor has a facility in Phoenix, Arizona. I visited. It's massive. Taiwan sector's got more room to grow.
And to your point, I mean, its customer list is just a who's who of tech.
Yes.
The other one I like to talk about, increased investment in defense and security. Why is that a theme? How do you want to play it?
So we recently learned that NATO countries have committed to spend up to 5% of their GDP on defense spending over the next decade. We know that the European Union is going to spend $840 billion US dollars over the next 4 years on defense spending. President Trump just included nearly $1 trillion in defense spending in the US budget. Where does that money go? Defense contractors. Here's an international play. We know international is outperforming US thus far this year significantly. One name to play? BAE Systems, the largest defense contractor in Europe and one of the 6 prime contractors to the U.S. Department of Defense that pay a dividend of about 1.7%. If you're looking to follow the money, the money's going into defense spending, and BAE Systems is one way to play that.
Would you want BAE instead of or in addition to a Lockheed Martin, a Northrop Grumman, in addition?
In addition to. This gives you some geographical diversification. Yeah. You mentioned Northrop Grumman. How about a company like Kratos Defense, which is building autonomous warfare so you don't have to put soldiers' lives at risk in war. So there's different ways to play where this money is going to ultimately be spent, but BAE gives you a little geographical diversification as well.
Last one I want, look to sources of power to help power your returns.
Yes.
What's the name there?
How about NiSource? It's a multi-utility. It's one of the largest distributors of natural gas in our country with over 3 million customers in states such as Pennsylvania and even Virginia. Virginia, which has become the capital of data centers of the world. So now utilities have become a backdoor play into the AI revolution. And NiSource has a dividend over 2%, nearly 3%. So you get the defensive characteristics of utility, the backdoor play into the AI revolution, and as the Energy Secretary says, natural gas is where we need to lean into right now to help power the AI revolution going forward, in addition to nuclear and other alternative sources.
And I'm just looking, you're in good company, by the way. Street agrees with you. I'm just looking, 80% of analysts covering this name say it's a buy, Kevin. All right,
That might concern me.
You'll come back to talk about the other side. While investors continue to eye risks around President Trump's tariffs, the market reaction to trade talks has seen quite a shift. We're taking a closer look with our chart of the day, and Yahoo Finance's Josh Schaefer joining us now with more. Josh.
In today's chart of the day, we're taking a look at how stocks have reacted recently to tariff headlines. So, of course, if you look back in April, the S&P 500 was moving quite a bit off these headlines, right? So this is sort of your start here. This is March. Of course, this is Liberation Day in April. And this is data from Goldman Sachs' David Kostin. He's the chief equity strategist over there. In purple, you're looking at a basket that GS tracks of tariff-related stocks. In green, you're looking at how the S&P 500 reacted. So sort of two key points here. One, the market, you could argue, was pretty rational during this sell-off, right? The S&P 500 falling 5% initially on that first day, while a tariff-related basket fell 11%. Of course, that makes some sense, right? Stocks that are more exposed to tariffs sliding more. But what's been interesting from sort of a macro perspective here is when we look at what's happening July 7th, July 13th, we got big tariff headlines those days. Both the tariff basket and the S&P 500 only moved 1% on July 7th and less than 1%, basically 0%, on July 13th. So what this has been showing us is essentially that right now tariff headlines, although we have a lot of them, we're talking about them every day on this network, there's a lot of letters coming out, etc., they're not really moving the markets anymore. And someone like Kostin essentially argues because there hasn't been a lot in the data that has shown that tariffs are as big of an issue as once feared. If tariffs aren't going to change the overall trajectory of profit growth for the S&P 500, then why would investors sell stocks? And so right now you're just seeing overall confidence despite the constant tariff back and forth. Of course, headed into August 1st, Josh, and really anything can happen as we sort of approach that deadline as we know.
And while I have you, Josh, I want to ask you about Mike Wilson as well. Another well-respected guy, right? Well-respected strategist, kind of guy. When Mike speaks, people tend to pay attention. What does he have to say? Because he is sounding increasingly bullish as well.
Yes, Josh, yes. And it's really sort of related to this concept, right? So Mike Wilson over at Morgan Stanley writing in a note to clients over the weekend saying that he is increasingly bullish, starting to consider his 12-month case for 7,200 on the S&P 500. So that'd be well over a 10% raise from where we are right now. I'll just pull up the actual SPX so we can get a sense of that. But overall, sort of what Wilson's arguing is essentially similar to Kostin. The overall growth trajectory right now looks pretty promising post-tariffs. If you're not seeing tariffs impact that economic growth story as much as initially thought, if you have earnings continuing to come in solid, then sort of the rally that you've seen in the S&P 500 over the last month, over the last 2 months, starts to make a lot of sense and is really fundamentally backed. Wilson would also point out earnings revisions breadths and the amount of earnings revisions that are starting to turn positive has been picking up as this rally has been happening. If you looked at a chart of earnings revisions, it would look pretty similar with that flow up. That is strong fundamentally for the S&P 500. So unless something shifts, Wilson highlighted maybe tariffs start to impact inflation more than we think, or I'll pull up the 10-year Treasury here. We talk about this one a lot, Josh. If the 10-year Treasury did indeed end up pushing up to 4.5% as it looked like it was going to last week, that'd be another key headwind. But without those headwinds right now, he's pretty bullish and he thinks the path is likely higher for the S&P 500 in the intermediate term over the next year.
All right, Kevin, 7,200 on the SPX, my friend. It sounds pretty good. What do you think?
That loud thump you just heard was me falling off my chair and hitting the floor when you use Mike Wilson and bullish in the same sentence. But I agree with his sentiments and his analogy right now. I've contended all along that tariffs presented more of a growth scare than they presented an inflation scare. And if we continue to see earnings growth expansion, that's going to be to the betterment of this bull market run that we're currently within. Whether we we get to that ultimate number or not, or it takes us longer to get there, I think there's more momentum behind where these markets could head, provided, of course, that the tariffs aren't as severe as we thought back in early April, and provided, of course, that the Federal Reserve ultimately steps in and starts lowering short-term interest rates.
All right, Josh, thank you. Appreciate it. Well, stocks continue to set record highs as strong economic data has mostly eased tariff concerns. Ian Wyatt, Huntington Commercial Bank Director of Economics, joining me now. Ian, it is great to see you, especially on set, as always. I'm going to start, Ian, with a headline in the Journal, and I want to bounce this off. You're, in fact, the perfect guy to bounce this off of. Here was the headline, caught my attention. Headline, Ian. The U.S. economy is regaining its swagger. And here's what they note. They say fears of economic downturn following Trump's tariffs eased as consumer confidence and spending rebound. They talk about how major financial institutions like JP Morgan, Chase no longer anticipating a recession. They talk about how small business owners are increasingly optimistic. Does this all, Ian, dovetail with your outlook, your perspective?
I think maybe it's a little more bullish than we are, but yeah, we see modest growth in the second half. We're going to likely see a really strong GDP print for 2Q, about 2.5%. And we saw, of course, the negative print in 1Q. Really, that's tariff noise. When you look at it underneath, you pull it apart, the consumer's still growing 1.5%, modest spending growth. We do see companies adjusting, adapting. I think initially with tariffs, there was sort of, it's like the stages of grief. They went from denial into acceptance. They've kind of moved from denial. I got so many questions, help me understand this. We had so many of our commercial clients at Huntington just asking us, help me understand what's happening here and how to play this. Some of them, waited, and I think oftentimes that was the best strategy because sometimes there was enough different moving parts where it was hard to figure out the right strategy initially. But a lot of them now have been moving and adjusting and figuring out how do we switch our supply chains around, how do we move manufacturing somewhere, how do we source from a different country or a different place, and you are seeing that adaptation style, or they're simply going to acceptance and saying, look, most all of that supply chain for X product comes from like one province in China. And so therefore the entire supply chain's there. No one's going to switch. Everyone's in the same boat as us. So we just pass on the cost increases. But I think what you're right about, is
you can always say when
inflation.
I'm right.
I'm sorry. I
never have to
apologize. On inflation, I think one thing when we talk about this is you look at the mix of what inflation is really, or the basket of goods. Goods are not that big of what we spend money on. It's maybe 20% of what we spend money on total. So the higher inflation from tariffs is really only maybe 20% of the overall spending.
What do you think? Do you agree with Ian's general view here?
I do agree with you. So what does the Federal Reserve see that we don't see? According to their summary of economic projections that they released in June, they believe the economy is going to slow to 1.4% by the end of the year. They believe unemployment is going to rise to 4.5%. And core PCE, their preferred gauge of inflation, is going to rise to 3.1%. What are they seeing that the rest of the market, myself included, isn't seeing?
I think that's probably a little more negative than I am. I would say what hit me in the inflation when the CPI report came out was if you looked at, say, services, anything labor sensitive, you still saw pretty strong inflation, 3.8% in food away from home, 3.8% on services ex shelter, year on year, of course, that is. And so you have still some labor cost push happening. But when I talk to businesses, that labor cost push is a lot weaker than it was, whether you're in transportation, something like that. There's still some of that lower end of the labor market. There's a little bit of that cost pressure pushing through. I think the Fed would like to see those come down because if we have goods have been helping on the inflation front, they've been basically at zero for a while. If we see a little bit of inflation there, the problem is we need those other categories to come down to get to that 2% PCE target. The Fed's models, as Powell acknowledged, their models don't really have precedent for this. They don't really have precedent. We've been in a period of lowering tariffs for 70 years. And now all of a sudden we're seeing higher tariffs and their models are built on data and historical precedent and they have no data.
Here, Ian, let me get your take and your response. When I have more, let's call it downbeat, for lack of a better, economists on the show or strategists, I think part of their argument seems to be, Ian, in broad strokes, that tariff inflation is coming. Just you wait. It's showing up in a month or two. It is too soon to pop any kind of champagne cork. What do you say to that?
I think it's some of it. I think, yes, there's going to be some inflation. Some categories will definitely do that. I was talking to one of a big home improvement company, and they said, certain supplies, we just don't have other sources. It comes in. But the reality is, if you look at what people spend money on for probably decades, the reality is what's gotten cheaper for Americans is things like TVs, electronics, anything manufactured. What's gotten more expensive is childcare, education, anything labor intensive. Over time, goods are just not that big a percent of what people spend money on. They spend money on housing, they spend money on healthcare, they spend money on services, and all of those kind of have very little relevance for tariffs. So that's where I'm a little more sanguine about, and I do see companies adapting. I see companies adjusting in supply chains, but we are also seeing a weaker dollar, which actually in some ways even adds to the tariff hit on an inflationary side for imports. But overall, I just don't see it as such a large portion of the spending basket that it's going to move the needle quite as much as people think. And so yes, probably there's some coming, but it's in specific segments and categories. And there's a lot of other categories. We think shelter's coming down. We think the wage growth pressure on services is coming down. And it's a net calculation that's pretty weighted away from goods.
Added up, then what does it mean for the Fed, Ian? Clients ask you how many cuts are coming. What do you tell them?
I kept going low.
How many cuts are, or how many cuts should be?
Should be and are. Okay, I think I probably would have cut a little earlier. I probably would have cut a couple more, because I see the housing market, I see some of these other areas of CRE. I always think that's part of how the president views the economy as a CRE investor. And those are a lot of his friends in his cohort, and that's the lens. Like all of us have our lenses, we view the economy. I think he sees it that way, and that's been a segment that's struggled with high rates. So I probably would have cut a little more sooner, but I don't think July's on the table. If you looked at the dot plot, we had roughly an even camp at 0 cuts and 2 cuts, with a couple at 1 and maybe 1 or 2 at 3 cuts back in June.
Yes.
You split out that dot plot there, but I think they want to get to more of a consensus that probably pushes it to September. And then maybe we get another one in October, and we'll see come December if 3 happens. But I think realistically, 2 still seems on the table. Although, you look at the markets starting to downplay even a September cut. I think we're only at a 60-something% probability of a September cut. But my best bet is we're probably at 2 cuts for the remainder of this year, coming September, October, and we'll see in December. This is a very data-dependent Fed. Partly because they don't trust their models.
Yes.
They've seen their models perform poorly, and they know, Powell explicitly said, we don't have precedent for what's happening, so therefore we don't think the models are very good at this. And we'll see if we get a couple more high inflation prints and jobs reports that are just good enough that the economy keeps pushing forward, maybe September pushes back to October. They keep procrastinating. I think this Fed's like they keep waiting. They're like, next month, and it keeps being another month down the road.
Ian, always great to see you, especially on set. Thank you for coming in.
All right, well, thank you. Thank you, guys.
Time now for To Watch Tuesday, July 22nd. We'll start off on the earnings front because earnings season is in full swing here with big names reporting on Tuesday. That would include Coca-Cola, General Motors, and Capital One. Coke announced results for the second quarter. Analysts expecting less growth in Q2 due to a slowdown in price increases compared to last year. Earnings coming after a Truth Social post from President Trump saying that he had talks with the company about using real sugar cane in its products, a claim that Coca-Cola did not confirm. Shifting gears to General Motors, GM also posting second quarter numbers on Tuesday. Analysts expecting the company to report earnings in line with analyst estimates, but like most players in the EV space, tax credit changes could cause issues for the automaker going forward. And sticking with earnings, we'll also be hearing from the defense sector, including reports from RTX, Lockheed Martin, Northrop Grumman, and Halliburton. And taking a look finally at the Federal Reserve, we're going to be getting some commentary on Tuesday from Fed Chair Jerome Powell. This is coming against the backdrop of continued pressure from President Trump to cut interest rates. Chicago Fed President Austin Goolsbee telling Yahoo Finance on Friday that Fed independence from political interference is absolutely critical. That'll do it today for today's Market Domination Overtime. Big thank you to Kevin Mahn for hanging with me today. And on the other side of the break, it is Ask for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.